In early 2025, a significant shift occurred in global energy trade. The door to U.S. oil exports to China didn't slam shut, it was quietly and ruthlessly sealed. China imposed a 10 to 15% tariff on American crude oil, LNG, and coal. This action didn't just affect trade flows, it marked a seismic change in the energy landscape. Chinese refiners, once major customers of U.S. energy exports, turned to alternative suppliers. Barrels from Russia, Saudi Arabia, the UAE, and even Iran began flooding the market, while American shipments to China dwindled almost to nothing by mid-2025. This was no ordinary trade dispute. It represented a massive realignment of global energy markets as China moved away from the US dollar and restructured its oil supply chain. The US found itself excluded from the world's largest oil market, left on the sidelines as China rewired its energy map. Let's break down how this happened and why the US may never find its way back in. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. 1. Tariffs sparked the collapse of US oil trade. In February 2025, China slapped tariffs of 10% on US crude oil and 15% on LNG and coal, forcing Chinese refiners to immediately halt their bookings of American energy products. Even when US producers offered discounted barrels, Chinese refiners didn't bite. Shipping data paints a clear picture. US exports to China, which had averaged about 160,000 barrels per day in early 2025, plummeted to near zero by mid-year. This wasn't just a brief interruption, it was a permanent shift. The brief 90-day truce, which reduced tariffs to 10%, did little to reverse the trend. The underlying economics had already changed. U.S. export terminals, pipelines, and shipping lanes, which had been built specifically for China, became underused. American producers found themselves locked out of a market they had come to depend on. The energy link between the U.S. and China wasn't just weakened, it was dismantled. 2. China's crude compass points elsewhere. As U.S. barrels disappeared from Chinese refineries, China quickly pivoted to alternative sources of oil. Discounted Russian crude surged, bypassing Western sanctions, while Saudi Arabia, the UAE, and even Iran became reliable suppliers. In fact, by mid-2025, Chinese imports of Iranian crude were estimated to be over 1.7 million barrels per day, with much of it circumventing formal scrutiny. These weren't just short-term solutions, they were long-term strategic moves. China secured multi-year, WAN-based contracts that locked them into non-US oil systems. Refinery activity surged, with throughput climbing by 8.5% year-over-year to 15.15 million barrels per day by June 2025, the highest since 2023. With an abundance of supply, Chinese refiners could store or export oil at will. This wasn't a temporary workaround, it was a permanent shift in the way China sourced and processed crude oil. 3. De-dollarization and China's financial sovereignty. But the shift in China's energy supply chain wasn't just about oil, it was also about currency. In 2025, China made a clear move to de-dollarize its energy trade. Long-term contracts with Russia, Saudi Arabia, Iran, and the UAE were increasingly denominated in yuan, sidelining the US dollar and increasing China's financial influence in global energy markets. This shift was far from symbolic, it was structural. By conducting deals in yuan, China not only sidestepped dollar-linked risks and sanctions, but also reshaped how oil was traded, paid for, and insured. US influence over global oil prices, once bolstered by dollar dominance, began to wane. Analysts noted a sharp rise in non-dollar oil contracts, making US crude less competitive even on price. For American producers, this posed a significant challenge. Even if US oil became cheaper, how could it re-enter a supply chain that had been re-engineered around non-dollar denominated contracts? The US wasn't just excluded from the buyer's list, it was excluded from the entire system. Infrastructure on standby and a scramble to recalibrate. The US had spent years building its oil infrastructure with one goal in mind: to feed China's ever-growing demand. Gulf Coast terminals, pipelines, and shipping lanes were all designed to deliver energy to China. However, by mid-2025, with Chinese refiners pulling back, all of that infrastructure sat idly. Redirecting U.S. oil to Europe, India, or Latin America might seem like a fix, but it isn't that simple. These alternative markets are smaller, fragmented, and fiercely competitive. Margins are thinner, contracts are shorter, and geopolitical friction makes long-term planning a gamble. U.S. producers now found themselves staring at underutilized pipelines and half-empty storage tanks. The infrastructure was designed for an Asia-centric model, and without China, it felt like owning a race car with no track to run on. Analysts warned that unless something changed, through bold policy incentives, unexpected global shocks, or new trade agreements, the U.S. export model might need a complete overhaul. 5 trade deadlocks and China's energy reboot. When U.S.-China trade talks resumed in Stockholm by mid-2025, energy wasn't even on the agenda. Washington threatened 100% tariffs on nations buying Russian or Iranian oil, but Beijing stood firm, asserting its energy sovereignty. A brief rollback of tariffs offered little hope for U.S. exporters. China continued to press forward with long-term contracts, yuan-based payments, and stockpiling strategies, reinforcing a permanent shift away from U.S. supply chains. By mid-2025, China's crude surplus had hit 1.42 million barrels per day, giving refiners the cushion they needed to weather market volatility. China also accelerated its electric vehicle, EV revolution, with over 14 million charging stations and nearly half of new car sales now electric. As the EV sector grew, long-term oil demand weakened, further eroding prospects for U.S. fossil fuel exports. Verdict, the final turn. Can U.S. oil catch up, or is the race already lost? The U.S. didn't lose access to China's oil market in one fell swoop. It happened gradually, through tariffs, contract lapses, shifting logistics, and China's strategic decisions. What replaced American oil wasn't just cheaper crude, it was a fully integrated system of supply, payment, and redundancy backed by yuan-based contracts and shielded from dollar dominance. Even after the tariff truce, China hasn't budged. Its buying channels are now optimized for Russian, Emirati, Iranian, and Saudi oil, and its EV policies are charging ahead. The future doesn't appear to have a prominent place for U.S. oil unless Washington can bring bold energy diplomacy to the table or Beijing decides to rewrite its roadmap. For now, American oil producers remain parked at the curb. Will the U.S. be able to rebuild a competitive export strategy, or has the race already been lost? Will China's EV push permanently reduce global demand for U.S. oil? Should American producers pivot to alternative buyers, or wait for a geopolitical reboot? If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.